Hello, everyone. Greetings. Welcome back to Tech Talk, the show where technology meets transformation. Firstly, thank you to our media partners, K Media Marketing, Borneo Post, Utusan Borneo, Sihua Daily, Oriental Daily, and TFM. Now, today's episode 3 is continuing our NASDAQ private market series, Unlocking Wealth Through Secondary Share Opportunities. Evolving markets, wealth creation is no longer limited to IPOs or early stage investments. A growing number of investors, founders, and shareholders are tapping into the power of secondary share opportunities and transactions that enable the buying and selling of equity in established private companies before they go public. This segment goes beyond the basics covered in early episodes, focusing on how secondary markets share opportunities, provide liquidity to long-term shareholders, create strategic entry point for investors, and open new avenues for portfolio diversification. We will examine the mechanics of these transactions, the role of valuation in a pre-IPO environment, and how platforms like NASDAQ Private Market streamline these deals with transparency and compliance. By understanding secondary share opportunities, stakeholders can unlock hidden value, accelerate capital recycling, and position themselves for growth in high performing companies without waiting for the public markets to catch up. Now, let's get on with our show. We have with us today Dr. Moradi. Dr. Moradi, over to you, sir.
Greeting everyone. Thank you for having us. Welcome to our Tech Talk show. We continue these programs on a weekly basis to inform, educate, and provide timely information that it can help the population, the community at large, as they're going forward into a new wealth strategies. Being in the wealth management and investment banking and mergers and acquisitions and IPOs and working in 22 public companies around the United States and globe has given me a broad perspective that I look at wealth as a long-term strategy. It is not about pumping and dumping. It's not about making money right off the shares by taking an inside information, because these are all regulated. And more importantly, with today's marketplace, AI has taken over the entire algorithm. For example, there are groups called quant, and you can look at them yourself, that basically they can't lose because of their algorithms. So now individuals are puzzled: how do we make money? How do we save money? And how do we have our money to make money for us? But then there are challenges. Like in the primary market, stock markets are extremely volatile. It fluctuates because we have markets that now is impacted by tariff, as an example. And the tariff now has created uncertainty for the investors. They don't know where to go, because now if they have operations in certain regions that the tariff is high, it impacts their revenue, their cash flow. In United States, the companies that they're buying supplies, as an example, that they had to pay maybe about $50,000 to buy parts, now they're buying it for $84,000. So that makes it extremely difficult for small businesses to create a value for their children, for their growth strategies. As a result of this kind of vacuum, a new market that it came together from 2011, now that it has matured itself, is called secondary market. Secondary market was really originally designed for companies that they do, late stage. They are ready at the pre-IPO and they want to go IPO, but these stocks are not available to the public. Like if you are a layman and have a 9-to-5 job and you're working for a company and you have your savings, and if you decide to go and buy ChatGPT stocks, it's not going to be available to you. If you're going to buy OpenAI or X or any of these new companies that they are coming as unicorn, that is a program that is excluded to the public, and it's only available to high net worth. And these high net worth individuals are the ones that they basically creating their own wealth at the expense of the main street. So one of the objectives that we have in here is to reduce the vacuum between Wall Street and Main Street by educating you and sharing some of that information and showing you how you can go about it. But more importantly, there is a challenge ahead of us. Which company do you invest? There is so many options now available. There are so many new startups are coming out. There are so many variables and risks because at the end of the day, when we talk with wealth managers, with Goldman Sachs, with the JP Morgans, with all of these guys, their only concern is about two factors: beneficiaries risk management, so they can reduce the risk and then provide liquidity for the people that they manage as their account holders. And these are normally people that, like in NASDAQ private market, you have to have about 5 million net worth going under what we call KYC and AML for anti-money laundering, and ensure that you're not a threat actor, but a legitimate actor. And then from that legitimate actor, you can start buying and selling shares. With that kind of a mindset, institutional investors are looking at the private market as a part of their portfolio. For instance, just recently, one of the things, not to digress from the subject line, Bank of New York called Mellon Bank and Goldman Sachs just announced that they will be providing a blockchain of $7.1 trillion to create the facility for digital assets. Up to now, if you go back and look at your own history as an individual, you're as good as your net worth. And your net worth is based on your assets minus your liabilities equal your equity. And when you look at your net worth, it was originally founded more on real estate stories. I got this land, I got this house, I got this property, I got this hotel, I got this facility, I got this golf course, things like that. And the bankers would love that because they would put a lien against your assets, and then they would lend you called credit facility or line of credit or equity line, and then you would be able to use that to facilitate those kind of things. But today's market, digital economy is far exceeding physical economy. So bankers could no longer ignore that if you were a software company and you wanted to go borrow against your IP, intellectual properties, they would simply deny you. But how could Zoom become a Zoom company without assets? How could Airbnb, without owning assets, become a publicly traded company into billions? So you have to ask yourself very simple question. If I am an investor and I want to create a saving for my children that they can create benefit that while I am gone or something happens, they can create continuity, that kind of strategy is progressive. It is not about getting rich fast by some of the scammers that you may see on the screen that they make you to put $50, $100, and then they start showing you a little screen that your numbers are going up. And then you feel confident, and then you subsequently start putting your own money, your life saving, your hard-earned money into that account, and you keep going forward till all of a sudden you see there is they call it a rock pool. They take that money, run away, and you never see them. In fact, there are buildings in Dubai that manages that kind of operations for this kind of threat actors. We looked at this kind of opportunities where we see the population at large, the people that they're really working in the main street to make their ends meet, especially with the high expenses that it's happening right now. If we don't set aside and create wealth, then your money is not going to make you money. So with that market opportunity came the strategy that Maxwell Rand strategized, and we put a company already into motion that it dated back from 2011, and then in 2023 we started it as a special purpose vehicle, and in 2025 we are a NASDAQ private listed company called Meta Exchange AI. In fact, Meta Exchange AI is one of the sponsors and partners with Borneo Post, with K Media, because originally they were the ones that they brought the concept of privacy security to the print publishers and allowing them to establish that kind of trust factor that they have earned over the last 70 years and targeting its audience without worrying about deep fake news. And as print media is reducing its size and production and circulation, then digital media is the only way to reach out to your audiences. So with that kind of a mindset, one of the areas that we looked at it was that how do we talk to you about secondary market? And rather than just us explaining some of these areas, we're going to share some video as what we call repurposing the video and sharing some of these ideas with you and sharing the news actually. So you can take a look at it and make a value judgment for yourself to see if these are any value to you or simply it's a waste. So take a listen on this particular video and then I'll continue with our presentation.
What is the potential risk to everyday investors?
Well, the risk to everyday investors, to start there, is that they don't know enough. By definition, these companies aren't reporting companies, so they may not know enough to really make intelligent investment decisions about these companies, and that's been a problem with some of these sorts of things in the past. Presumably, though, NASDAQ will issue its own rules and regulations saying how much information and disclosure is going to be required of these companies to list, and that may help solve that particular problem.
Professor Ritter, your general take on this, is it dangerous in any way for average investors?
Well, the devil's is in the details. Currently, Shares Post and Second Market are allowing trading for accredited investors in private companies. It's not clear whether the NASDAQ private market is changing anything, whether they're going to be allowing non-accredited investors to trade, whether they're going to have different required disclosure than the existing private markets have.
Okay, so I'd like to pick up on that point of accredited versus non-accredited. And
Right.
Bob, just to remind everybody, accredited means you have $1 million in cash, not counting your home, that
Right.
you are able to invest, $1 million or more.
Right, $1 million or more. Now, remember that NASDAQ doesn't get to change the rules about who gets to invest in these things. That's the SEC, and these are private placements. So it is going to be limited, unless there's another change in law, to accredited investors only. The interesting question there, I mean, it's a very reasonable question, though. What does it mean to have a listed private company? Because until at least the regulations under the Jobs Act become final, you can't even talk about these things. So you can't talk about them. There's no particular information about the company. So it's kind of unclear what this means at the moment.
Although, Bob, I would say, I mean, there's a lot of private companies, and you have contacts at numerous ones here in the city who, quite frankly, they're trying to keep their books as if they were a public company.
Absolutely.
I mean, there's an internal discipline that suits them as well, but I guess it's just too difficult to trust that everybody has the same standards.
Well, right, but NASDAQ can enforce those standards in terms of disclosure. And what I think the longer term picture here is that this is where the world is going, for sure. There will be more liquidity in these early stage companies going forward. Investors in them will be able to swap the shares and take their tax losses at the end of the year. So this will help the startup ecosystem.
Professor Ritter, I'd like to bring you back in on this point. It's something that relates to what Bob was just saying. If a company has its books in order to be a publicly traded company, shouldn't that company just go public?
It all depends upon what's best for the company. Many companies, especially in the technology area, are choosing to sell out in a trade sale and never go public. So one issue is, should the company remain as an independent company, whether it's private or public, versus should it sell out to a bigger company in a trade sale?
Okay, so that's an interesting point. Bob, I want to bring in Facebook, right? Because we talked a lot when Facebook went public, and a lot of people said, public investors said, you know why this turned out so poorly for public investors is because Facebook was trading for 2 years on Shares Post.
Yeah.
For 2 years on second market, other kinds of exchanges, and that's why public investors got hurt.
Right.
Is there something to extrapolate from this example, or was Facebook such a one-off just because of its size?
Well, there are several things to extrapolate from the example. One of the reasons that its share price ran up so much was the classic buy on the rumor, sell on the news sort of thing. The idea was, hey, I'm getting in on something that no one else can get in on, and when it goes public, it's going to pop like crazy. I'm going to make a fortune. So nobody paid attention to the underlying economics, which, by the way, largely they couldn't, because the information wasn't available to them. So I think that the lessons here are, again, you've got to have some real disclosure of these company financials before you make the investments. And if this becomes the normal standard way of doing things, then there's going to be less hype around getting in on something before the IPO and the big pop.
Professor Ritter, do you feel like those are the lessons learned from the Facebook example? Do you see it in a different way?
I think those are legitimate concerns, but on the other hand, Apple has fallen by 30% in the last 3 months. That has nothing to do with the failings of public markets. Facebook's value fell as well. I think it's a little too harsh to say that private market speculation was responsible for that fall. You know, any company could have a change in investor expectations that might result in the price increasing or decreasing, like Apple's has recently.
But Professor Ritter, from what I understand from the Facebook example, it was pretty much an example of what not to do from start to finish.
With the Facebook IPO, there were certainly several glitches. For instance, the first day delayed trading.
No, but
and
even
the lack
before
of trade
that, I'm talking about
confirmations.
the pricing, the investment bankers, Goldman having the lead and such a strong lead, even far too much gray space between Goldman and Morgan Stanley and other participants. I'm even talking pre-market.
I'm not that critical. With 2020 hindsight, yes, there was too much optimism about Facebook's offer price, but this has happened with many other companies as well. I think the bigger problem is not private markets here, but it's the whole book building process where investors, institutional investors, don't have the right incentives along with investment banks in terms of trying to focus on long-term value rather than making a quick buck.
Bob, you have a comment there.
Look, there are a lot of good things about having some liquidity, even in private shares. No one would dispute that at all, certainly not me. One of the best things about it that's very important is that the employees in these companies tend to be young people, childbearing age, and if it's going to take a very long time to really go public, they need some ability to liquidate their shares and get cash to actually live their lives. So that's a big plus.
So from the presentation that you just saw on the video from Bloomberg interview at the stage, the secondary market is becoming a dominant force because of the family office, because of the private equity, because of the institutions. And in fact, we are in the wealth management services, we, along with JP Morgan, Goldman, Merrill Lynch, etc., we all recommend to our investors to move part of their portfolio, approximately about 60% of it, to the secondary market and keep the other 40% in the primary or into the digital currency or crypto or these kind of things that now has been endorsed. And institutions like Mellon Bank can provide you with the SBL lending facility through those security-based assets. In fact, as we are speaking with you, we are speaking with several wealth management group out in New York that they're going to partner with us. And the idea is that when you start working as an employee for a startup, because we are doing one ourselves right now, it's a unicorn from Silicon Valley, that basically it's a disruptor's disruptor. And then at the same time, we know this becomes a unicorn organization because of the team that we assembled as management and the experts that they are in that marketplace. And every day we get a better welcome by different players that they're coming either as our management team or advisory board because they want to change the game. But we don't want to hold off our employees that they have devoted their time and they have set up certain things because they also need liquidity. The early investors that they took the risk with you when you were a startup, call it in the family friends round, they don't want to wait for 10, 15 years to get liquidity. So these are all becomes barrier and obstacle because the guy who wants to invest, he wants to have accessibility to liquidity, mitigate his risk or her risk, and take these two together and build an account that we call it wealth management. And under wealth management, now you create and gradually increase your portfolio. It doesn't have to be in one day, but there is two factor. Main Street doesn't have the Wall Street, as you heard just recently from the announcement. Not everybody is a millionaire to have $1 million cash in their bank account and not including their digital or their real estate assets and other portfolios. So when you take that into consideration, liquidity becomes part of that equation and risk management becomes part of that. But then take yourself from secondary to the primary market and you see how a stock market has become volatile. In one day, it drops 1,000 points. Some people predict that market will crash because of the high inflation, high cost, not enough return on the revenue, and so forth. And those factors now creates the perfect storm for what we call the stock exchange, because that's where you have what we call the sharks. They are the day traders, they are the share shorters, they are the naked shorters. And if you're familiar with that kind of wealth or trade strategies, you know what we are talking about. And if you are not, then you are just creating a saving account and putting your money, and the bank simply gives you a very fractional return on that. And but they tie up your money and then they go become institution themselves and invest. We think of this kind of things in today's market needs to be revisited by a new light and dimension. That's why we are working around the globe from LATAM to Australia to United States and Europe to spread this message, including into our colleagues at Borneo Post and K Media audience, that why we are telling you that you need to look at secondary market as an opportunity. Now, there are two sides of this. One is you either have an established company, okay, because these are late stages. Remember, you have to have certain qualification to meet that. So therefore, you essentially are building a business and you hope your business eventually either goes public or you sell out to another bigger company so you can cash out. These are the way that entrepreneurs generally go about it. And this has been happening to me personally over my last 45 years of career, if you will. We try to bring the company to a certain level and we either merge or sell or leverage buyout or go IPO. And then that's how we open up the bottle of champagnes. Everybody's happy and we move to the next chapter. Now, with that mindset, these companies are small enough that they don't qualify for NASDAQ. And that is one of the reasons we brought Meta Exchange AI Inc. in a two-growth or two-pronged strategy. One is that we are growing within the market and we love APAC market. So we are focused in that region because we see a diversity. We see a group of people that they need assistance in the next generation. And also they all want to have a piece of stock market, a viable stock market that they have liquidity. And NASDAQ, it's a well-known brand since 1971. So we are not making it up. We are presenting you with the trust factor. The other side of the equation is the smaller investors that they cannot afford to be part of that NASDAQ private market club. So they can buy shares of publicly pre-IPO, publicly traded companies. So therefore, we created Maxwell Rand Pipe. So with that pipe, we help out the investors that they have less than $25,000 into that kind of an investment portfolio. And then subsequently, they put that in here. And if there are larger investors and they are accredited, we simply introduce them to the NASDAQ private market designated officer that we work with, and they make sure that all the I's are dotted, T's are crossed, settlement is done properly, and transactions are transparent, because everything gets done under that premises that you are a pre-registered, pre-IPO company, and you, at the time that you feel and your board and your stakeholders feel that you're ready to go public, you pull the trigger and you file a registration statement with SEC as a revision, and then you go into a period known as quiet period, and 3 months later you are trading on NASDAQ public. So, excuse me, that kind of a setting unfortunately, the allowance of this kind of establishment allows us to create the capabilities and create the wealth management for the clients at the main street, and then connect that to the Wall Street, and then give them their own accounts as beneficiary that the beneficiary can check out. And when the time arrives and they need liquidity right now, you're working around the globe with different SBL, security-based lending institutions, from UK to United States to HSBC and other organizations, that they are actively involved in the secondary market to provide a lending facility. And that lending facility, now what it does for you, you technically become your own bank. So therefore, through the taxation and the structure that the company sets up for you, you borrow against your own assets, you do what you need to do, and when you put that in here, that expense justifies that without touching your assets. And that capability allows us to now provide portfolios, and the portfolios can be housed through a custodian, and this custodian traditionally are banks or financial institutions that are registered. And more importantly, one of the things that we are experimenting right now in Europe, for example, is that we can even take your secondary and make that into a digital currency, and using your digital currency and place it in an account and giving you line of credit, equity lines, distributions that you can do for your personal and well-being when you need it, without really touching your asset, and you build your portfolio. And then over the years, as we go older and so forth, that portfolio becomes what we leave as a nest for our family, and a trust that it allows them to create guaranteed income. Example of that is KKR in United States. Those of you can Google it, take a look at it and see what the company is all about if you don't know. But KKR, for example, got together with Capital Group. So therefore, they can create a combination of public and private and create passive income. So therefore, they can give you dividends. This kind of establishment now gives you continuity and business model. And that is one of the reasons we felt these are important. And more importantly, to share another video with you and conclude our session, we are going to give you this interview that it tells the story, so to speak. So take a listen.
Welcome to Equity Matters, Navigating Equity Compensation, a webinar series hosted by Countsy. Today, we will discuss the secondary market and tender offers with Tom Callahan, CEO of NASDAQ Private Market, Martini, founder of Countsy, and Kareen, founding partner at Compass Strategic Advisors. We hope you enjoy this conversation, and Kareen, now over to you.
Well, welcome everybody. I'm glad to have everybody here with us, and we are going to have a very interesting conversation today about the private market. I think even my mother, who's 87, knows about the private market these days. That you can't turn anywhere anymore and not have an article or a news flash about it. It's definitely become something that everyone wants to talk about. Excited to be joined by Martini from Countsy and Tom from NASDAQ Private Market. Tom, would you mind just giving everybody a quick introduction on your background and NPM?
Sure. Well, first of all, Kareen, thank you for having me. Your mom is more informed than mine is. I think she thinks I'm still a stockbroker, although I've tried to explain what I do for a living many times. But I am the CEO of NASDAQ Private Market, and we're a company that services other private companies, and we assist them with managing their liquidity, largely for their employees, but for also early round investors. And it's really a story about how the capital markets are changing, and there's more private companies, and they're waiting longer to IPO, and that creates real liquidity pressures for private companies, and we try to help them solve those problems.
Great. And Martini, can you tell us a little bit about yourself and Countsy?
Sure, I'm the founder of Countsy. We do outsourced equity administration for larger private, smaller public companies. And we also, of course, do outsourced accounting, finance, and HR for early stage companies, spin outs, scale outs. We're very focused on the tech and life science industry. And we work with hundreds and hundreds of VC-backed companies in that space. But we're super happy to be involved in the equity administration side. And Tom, really appreciate you taking some time today to chat with our audience here. A really interesting topic, secondary markets. And of course, because we work so much with venture-backed private companies like tech companies and life science, this is a really interesting topic for them. We have seen a big uptick, as you're going to talk about, in this sort of activity at these companies as they try to get their employees some liquidity. So definitely interested in the topic, and I think a lot of people will learn a lot today.
Thank you, Martini. Thrilled to be here.
Yep.
Well, Tom, let's just, so we set the bar correctly. Can you just give a quick overview about how a liquidity program works, just so for those people who've never participated in one or understand how they work?
Sure. Yeah, and just to set the context, and I think everyone's aware of this, but if you look at the number of publicly traded companies in the last 25 years, the number has dropped by nearly half. There was over 8,000. Now I think there's just over 4,000. You go back a decade, there were about 50 private market unicorns. Now there's 1,500. So something big and important and profound is happening in the capital markets. And the output of that is that there are more private companies, and those private companies are getting larger, and they're waiting longer to IPO. We're coming up on our fourth year of an IPO drought. It's gone on so long that people are wondering, is this permanent? i.e., has something fundamentally changed in terms of private companies' desire to ultimately be public? So as long as there's more private companies, and as long as they're waiting longer to IPO, that creates liquidity pressures for founders and C-suite managers. It's kind of hard, Kareem, when you hire a 25-year-old software engineer to tell them to wait till they're 40 to buy their first house. And the average company now waits close to 15 years to IPO. So that's a pretty realistic time frame. If you want to attract and retain and hire the best talent, and there still is a war for talent, and if you just happen to live in a space like AI, there is a vicious war for talent. Your employees expect liquidity. And so that happens in its most basic form in a tender. And this is the core product that NPM offers. In a tender, the private company is our client, and they hire us to essentially effectuate a share buyback. These tenders started in the early teens, 2013, right after the Jobs Act. The first generation of companies to do tenders were Facebook and Groupon and Zynga, and they were very complicated processes, largely done on emails and spreadsheets, just getting the cap table straight and making sure that people didn't sell shares that they didn't own. They were laborious, they were long, they were expensive, oftentimes unsuccessful. And so we created a product about 12 years ago to really automate the tender process. So since then, we've done over 60 billion in tender volume. We'll do somewhere around 100 tenders this year, probably close to 10 billion in volume. So the tender really is now viewed, I think, by many private companies, Kareem, as a standard HR benefit. The same way you offer 401k and medical benefits. Well, if you're a private company, especially if you're competing against a public company, that has 3-year cliff vest RSUs that employees can sell into their Charles Schwab account. If you want to attract and retain and compete for talent, you have to offer regular windows of liquidity. So that's what we do here at NPM.
Tom, would you say there's a size of company that, like, before a certain size, they shouldn't be even considering this? Is there like a cutoff point where you think, is it a age of the company? Is it number of employees? Is it how much revenue? Is it stage of funding? I'm just interested.
Yeah, well, I'd start by saying there's a success bias to tenders. Companies that are succeeding do tenders. Companies that are struggling don't, right? If you're a struggling company worried about running out of capital, you're not particularly worried about employee liquidity, and your equity is probably not rising in value. So even if you were, it probably wouldn't be helpful. So the companies that most frequently run tenders are the ones that are succeeding. The typical profile, Martini, is Series C or later. We do some Series B companies, but usually they're a little bit too early on. So I'd say Series C and later, and the typical profile would be a company that has just done a primary round at a significant step up to their last. So they last raised money, 2 years ago at a $300 million valuation, and they're raising money this year at a $5 billion valuation. Well, all your employees can get out their pencil and on the back of a cocktail napkin work out about what that means to them. And then all of a sudden the calls start coming, well, when do we get to sell? Mm-hmm. And for a lot of managers, that pressure literally becomes irresistible. And so they then turn to us to run a tender for them. Now, tenders come in a couple different forms. One is if the company has the money, that use case I just described, they just did their Series C, they raised money, they want to take part of those proceeds and offer liquidity as an investment in their employees. That's a pretty standard straight share buyback. Increasingly, what happens is that private companies come to us and say, listen, we'd very much like to run a tender, but either we don't have the capital or we don't want to use our capital for that purpose. So NPM, can you please go try to find an investor to underwrite our tender? And then that's really interesting for us because it gives us an opportunity to go to market, tell the company story, bring high quality investors in, oftentimes that will for the first time be coming onto the cap table. So that's the part of the job that we really enjoy.
Yeah, that's great. And actually, that's an interesting signal to the market too, because I've been thinking about this early stage companies as they're attracting funding. They want to make sure VCs are going to want to invest in them, but it's almost as if secondary sales and tenders have become normal now. So it's not a bad signal that you can't raise money other ways or whatever. It's really interesting, especially when they do it professionally with a firm like yours, where it's very clean, very organized. I think it's a great option for companies.
Well, it's such an important point that you raised, because I think historically secondaries of all shapes and forms, and tenders are one form, there are others. Historically, I would say the kind of big VC Sand Hill Road community really looked poorly at the idea of secondary, because the idea was like, hey, I just put money into your company and now you're cashing out and our interests aren't aligned. And does that send a signal that, you as management or you as an early round investor aren't committed to or don't believe in this company? And that negative signaling was, a big reason why some companies never did tenders. Well, I tell you what, the market got over itself on that topic a long time ago, or at least in the last few years, because it's just the reality. Again, back in the year 2000, where the average company waited 5 years to IPO, sure, hey, tell people, wait 5 years and we'll IPO and we all get liquidity. Well, when it's 15 years, and some of the biggest companies in the world right now are sort of hinting they may never go public. And that's a whole nother discussion is, what are the incentives or disincentives around being a public company now? But if you're a private company and you may never go public, well, how are you going to incentivize your employees to keep working and offer them liquidity so they can buy houses and wedding rings and pay off loans and all those things that mortals do? Really, really hard to do that without some regular cadence of liquidity, which is why I said, it's sort of starting to be a basic HR benefit. So all those conversations about negative signaling, I think there's just a cold, hard reality of 2025 that almost never comes up anymore.
And a big issue too, a big concept about these offerings is that it isn't somebody gets to sell all of their shares. Like if you're with a company that goes public, all of your shares suddenly go into a pool that after the lockup you can sell them. But with these tender offerings, it's a percentage. I mean, Tom, what would you say is the percentage that you see companies allowing their employees to sell? Is there kind of a standard number?
Yeah, there is. I'd say on average around 15%. Sometimes that fluxes up to 20, sometimes as low as 10. But that's the general rule. Obviously companies want to give employees liquidity to live their lives, but they don't want them fully cashing out so they can leave. And so I'd say the average tends to be around 15%. The average company that we service does 3 tenders with us before they go on to wherever they're going to become. And the average cadence is about every 18 months, although we do have companies that will do multiple tenders within a year. Those tend to be companies in very, very fast growing sectors like AI. If your valuation is doubling, every 6 months or tripling every 6 months, we'll see those types of companies do tenders at a more frequent cadence. But I think on a general basis, you're talking about tenders about every 18 months, about 15% of vested holdings.
And Tom, I think too, just to make clear to everybody, the company is really in control of how they want to design this. So for instance, we see a lot with ex-employees, it's either you sell 100% of your shares or none of your shares. And I've seen tenders where it's you have to be fully vested before you get to participate. So it's really up to the company to decide how they want to design this. And I think working with your team, they can kind of understand best practice, but in the end, they have to think about what their motivation is for doing this and what their goals are as they design this. Is that correct?
That's a great point, and that's all very true. So the first thing I'd say about a tender is they are completely discreet. That's really important. When a company hires us to do a tender, we sign our life away in confidentiality agreements. I can't even tell you who my clients are. I can't tell you who participated, how big it was, what the price, nothing. And that's how the companies want it. These are very discreet programs. That's important to virtually every client that hires us. To your second point, control. The company controls every single element of a tender. How much employees can sell, who gets to sell, what they get to sell, vested, unvested, employees that have been here since 2000, before 2019. They control the price of the tender, the allocations, everything. It's a very controlled process. Again, really, really critical to companies to have discretion and control. And yeah, you're right. A lot of it is, what are you trying to solve for? Are you really just trying to attend to the liquidity needs of your current employees? Okay, well, maybe then that's all who's eligible. A lot of companies, one of their objectives is managing the cap table. Maybe they want to buy back some equity. So yeah, they'll include former employees, and for them, it's all or none. It's not 15%. It's either you sell us everything or you sell us nothing, because what they're trying to do is, control the cap table, buy back some equity from former employees. Another objective may be taking out early round seed, Series A investors. You're going to think I'm joking with this analogy, but I'm not. A very typical use case is a founder who borrowed 150 grand from his mother-in-law, 11 years ago, and it's now worth $27 million. And your mother-in-law is calling you every 48 hours saying, when do I get my money? That is a very typical use case, and that's an awkward situation. So sometimes with those very early seed round investors, similarly, all or none, we'd like to buy your shares. Sometimes it's just because of personal conflicts like that. Oftentimes, those early seed round investors that got you from 0 to 1, are not going to be the investors who are going to help you become a decacorn, then beyond that. So sometimes it's just a rotation of investors to kind of the next round of strategics that you want on the cap table. So those are typically the use cases for why companies do tenders. It's either employee liquidity or managing their cap table for one of those purposes.
Right. Well, Martini, just to you touch on two topics that are important: tax and accounting. So can you just comment on those? Some employees may not understand, am I taxed on this? How does that work? And then the other question is, as a company, should you be concerned about the accounting of these programs? Does it matter how you design it? So maybe just touch on those two things.
Sure. I mean, I think it does matter how you design it, but at the end of the day, these generally are taxable events for the employees. It does depend very much how you design it. We would generally say you have to have a tax professional in the mix when you're designing your program. And you need to understand, is this going to be a taxable event for my employees? Does it run through the W-2? In which case you're then also paying employer taxes. So there is a real cost to running these programs to the company from a P&L perspective. So there's two kinds of compensation, right? There's the compensation that somebody is taxed on that shows up on a W-2 or a 1099. And then there's this sort of more nefarious concept of GAAP compensation, where it is a non-cash charge that runs through your P&L. I would say most companies tend not so much not to care about it, but it is certainly non-cash, but it is a real number. So generally speaking, and when the company's working directly, like with a Tom at NPM, if the company's highly involved in the secondary, you're certainly going to have a GAAP compensation charge. And if the price is over the 4NA, of course, you're certainly going to have a GAAP compensation charge. And there's a whole decision tree you go through. Is the company involved? Is the company showing financials, which would otherwise be private? Is the company facilitating the transaction? All these things kind of lead towards that concept of there needs to be a compensation charge run through the P&L. And so, but I would say if I was a founder or a company management, when I'm trying to design a program, first of all, understand the tax ramifications for your employees and how they should be reported. Secondly, worry about the GAAP compensation, because if the answer to the first one is that it's taxable and runs through the W-2, it automatically shows up on the P&L. So the first person to go to is your tax firm and your tax professional. Second, worry about the accounting. That's how we think of it, Tom. Anyway, you might have a different opinion.
No, I think you articulated it perfectly. There are a lot of very complex and nuanced tax issues, NSOs and ISOs and RSUs and options. And that's just for employees. For the companies, they're equally complex. So yeah, the first motion we're not tax advisors. We have a very good network of tax advisors that we refer people to, but it's just not our business. And you need a lot of specific knowledge about the business and where they operate and what they do. So we don't provide those services, but we refer to people who do. But yes, the first motion of most of our clients that are contemplating tenders are tax advice and legal advice. It starts there. And oftentimes those are both actually referral channels we'll get from our tax partners or our law firm partners will call us and say, hey, one of my clients called me and they're thinking about running a tender and can you help them? So you're exactly right, Martini. That's the right first move.
It's become so, well, common is a wrong word, but like even when we talked about taking seed investors off your cap table, every seed fund is thinking about the way their capital should be liquidated, and they're interested in taking money off the table as they go through the life cycle with the company. And because it's become so much more common now, like I was involved in some very early tenders such as this that were much more privately run. Nobody knew what we were doing. The tax accountants didn't know what to do. The lawyers didn't really know what they were doing. It's become so much more common, and there's such a body of evidence now. There's like a ton of experience out there from professionals on how to manage these programs. So someone shouldn't be trying to work it out on their own. If you're doing it now, it's been done before. Let's get some expert help.
I agree. And one of the sort of informal services that we offer here is referring our clients to other CFOs and GCs and companies who have been through similar challenges. There's always a lot of demand for that sort of informal networking. And we find the CFO community in particular is very collegial and helpful. And if you call and say, hey, I understand you might have run a program earlier this year, and I think we might have some similar challenges. And how did you attack this problem? We find that informal networking is very, very helpful.
Yeah, and we shouldn't forget too that many of these are global. So you're not just dealing with U.S. tax issues. You're not just dealing with U.S. employees, but Ken, you'll correct me if I'm wrong, but you do have KYC requirements, know your customer, and you've got people in other countries. And I can remember in early tenders, we would go and say to someone in another country, we need your driver's license or passport or whatever. I think we needed their utility bills too, and they just refused to give it. They're like, no, I'm not giving it. And we were at a real difficult situation where, well, then you can't participate. So I think that's another thing. The whole global aspect of this is something to think about as you're designing this is, are you willing to support people outside the United States in this program?
Yeah, I mean, it's a tender is a regulated process. NPM, we have a broker dealer called NPM Securities. So when you participate in a tender, you have to open up an account in our U.S. broker dealer, and we have to AML KYC you and all those normal processes. So if people don't want to participate in those, then they can certainly opt out of the tender. But given it is a regulated process and we're a regulated broker dealer, those are really non-optional steps that we need to go through, no matter where you're domiciled. That's just kind of how the process works.
Yeah.
Tom,
so you've been.
Tom, I just have a question for Tom, just on that note of going through that process. If somebody comes to you today and says, I'd like to be running a tender, what would you, and it's a large private company that has all of the metrics that you mentioned about being able to run this, is it a 0 to 6 months before you can get it live? Like, give us a sense of the timeline. What would be the expectation on how long will it take to get the program up and running and actually selling shares?
Yeah, we like to have about 30 days. By regulation, that's for the pre-program setup. And then by regulation, the tender needs to be open for 20 business days. So then you're at 50. Call it another 5 martini post for settlements and wires and all that stuff. So that's ideal. We have certainly done it, and this happens at the end of the year. We'll get a call on December 7th, someone saying, I need to do a tender by the end of the year, and then we scramble. Partly it comes down to, again, where's the capital coming from? If the company's funding the tender, i.e. they have it on the balance sheet, we have gone from 0 to open in 48 hours, so we can move very, very quickly. If we're not redlining NDAs and customizing deal terms, especially if it's someone that we've done a few programs for before, we can stand these things up pretty quickly. Where it gets more challenging is if we have to go bring a third party in to underwrite the tender. Very hard to do that in 24 hours. There are some companies that we could, if you're one of the hot, AI space names that everyone's looking for. Yeah, we could probably help under short notice, but companies like that tend not to need capital because they've got all they need for let's call it a normal company. If there's a process where we're going out and bringing investors, minimum 30 days, that could take twice that because we're just having to go out. It's a mini road show, right? Yeah. We're telling the story, we're putting a pitch deck together, we're playing matchmaker, and it's a hard process to rush. So I'd say if the company's funding the tender, could be very quick, but ideally kind of like that, have that 30 days, 20 days, 5 days, that would be sort of the dream state, could be accelerated. But if you're actually asking us to do cap intro, then, a little bit longer than that.
Awesome.
Well, and another thing I think that's going to impact that timeline, and Martini, I want you to comment on this, is whether your cap table's clean. And you mentioned it earlier, Tom, but let's talk a little bit about that, because if you're 90% sure it's right, I don't think you want to do a tender, right? So
the importance of keeping I think this is such an old story that your cap table has to be the most pristine thing about your company. And so most of our venture-backed startups, and typically you've gone through rounds of diligence. So technically speaking, your cap table should be clean. But it's been surprising to me how we do come into companies after raising formal rounds with institutions where the cap table still has some missing pieces. Either the cash hasn't been recorded for shares that were actually sold, or, oh, we did issue those shares, but we can't find the board resolution or whatever. So using a professional firm, whether that's your lawyer, certainly in the early stages, companies tend to use their law firm, but be on a platform. Don't be running your cap table on a spreadsheet. There's so many good products out there. I'm not going to talk about any of them here because, there's lots of really good ones, but use a platform, use a professional, whether that's your law firm or a firm like ours, to manage your cap table. Just make sure someone's reconciling it. And as the founder, you should be looking at your cap table and make sure you're recognizing the names on there. So yeah, I think it's pretty important. Super important.
I'm not nodding in violent agreement, Martini, because I would say it is the rule, not the exception, that when we start engagements, the cap tables are incomplete. Depending on whether the company's DIYing it on a spreadsheet or maybe using a third party, depends how incomplete they are, but they're almost all incomplete. And you're right, they have to be pristine to run a tender, or bad things can happen. So that's always the first step, and that can be time consuming depending on how much work there is on reconciliation. The other place, and actually this for me is the funnest part of a tender, generally when we do one, we start off with a town hall. And, a tender is an interesting thing. It's been called the IPO alternative. And certainly it's not the same sort of life-changing event, of an IPO. It's what every private company employee dreams of someday, that they'll be maybe standing up on that podium. But it's not that far from that, especially if it's a company that's doing their first tender. I talked about the success bias, companies that do tenders are winning, they're succeeding. And oftentimes, this is the first time that employees have really felt the success, oftentimes of a decade of hard work. And we see this because the average employee in our program gets about $500,000. That's the average. And so, we wire the money, and they go from having $800 in their checking account to now $500,000, and it's life-changing. And it's just fun to be part of that. And so we start off every engagement with the town hall. And you'd be surprised. I would say generally financial literacy in this country is not what it should be. But a lot of employees don't know what tenders are. They understand conceptually that they're probably going to be able to sell some shares, but really what it is and the details. And Martini, we always get tax questions. We always get wealth referral questions. And so we try to support with, referrals on both of those fronts. But it's really fun to engage. Oftentimes, we'll have thousands of employees, literally they all show up to this town hall, trust me, because they're all quite interested. And we get to talk a little bit about who we are, explain how the process works, what a tender is, what their expectations should be. And it's really, really a fun part of the process because there's, like I said, it's not the same thing as an IPO, but it ain't that far away from there.
Yeah. I heard this story recently. A stock administrator was sitting down with this woman who worked for a manufacturing company, and she'd been there 9 years. And she said, so let's pull up, your account and let's take a look at it. And so they're kind of showing her how to read, what she has. And at the end, she says, well, this is great. Can we pull up my account? I want to see what I have. And the woman's like, this is your account. She's like, but this says I have $200,000. And she's like, yes, you have $200,000 worth of stock in this account. She said, I had no idea. And to me, the moral of that story is for 9 years, this woman didn't know, there was no motivation. There was no retention. She didn't know. So I think these town halls are good just to remind people, hey, you're not just getting your paycheck every month and your benefits are paid for, you're getting more than that. But Tom, one thing I hear from people who ask me about tenders is, well, if I do one, then am I kind of stuck? Like, do I have to do it every year now? Is there an expectation? Are my employees going to bug me every 5 minutes? Like, when's the next tender? Are we setting people up for that? What are your thoughts on that?
Yeah, my advice to companies is that you really do need to take affirmative control of your employee liquidity. I think some founders may just hear no evil, see no evil, I'm just not going to deal with it. But Karine, this because you've been around this space, a while. If employees need to buy a house or a wedding ring, or they're getting divorced or whatever, and they need liquidity, they'll get it. Now, they may do something you don't like. There's a whole black market in these things called forward trades, where employees will essentially do an off cap table derivative at obscene fees because they need the money, or they have some very, very predatory lending products that are in the market against private shares, and they'll go do those because if people need money, they need money. And that's bad for your employees. It's bad for your culture. It's bad for your company. So I guess, am I locked in? You're not locked into anything, and life changes. But if you keep succeeding as a company, I think I would look at it the other way to say, if I'm announcing, okay, our intention is every 18 months to do a tender, it's sort of, I don't have to have the conversation, right? This is my plan. Life can change. Maybe it extends, maybe it shortens, but you should plan on something around every 18 months doing a tender. Again, the company has full control. They can do it a larger tender, a smaller tender. They can narrow the aperture of who's available or who's not. So you're not held to anything. But I just think, like most things in life, being clear and predictable actually makes life less stressful, not more. And it's going to prevent your employees from doing something that are really not in their best interest.
That's a great point. And I think that whole concept of employee retention, being transparent with your employees, because it is a little tricky balance on being transparent on what was the round raised at, what is the new 49A. I think the world has become so much more transparent now that like 20 years ago or 15 years ago, people had no idea what the latest common stock price was. Those days are over. So any founder that's still living in that world really needs to think, and our management team really needs to think about, this information is going to be public, whether it's that employees are telling each other what they got granted at or whatever. Let's just all be transparent, make sure people are aware that it is company confidential, and have good corporate governance around stuff like that people are signing. Company information is confidential, that kind of thing. Have a good corporate culture around what company information stays inside, and really be transparent with your employees if the goal is to keep them and to continue to compensate them.
Yeah. Well, we're coming up to the end here, but let me ask one more question for both of you. So if I'm an employee, first of all, I have a stock option, so I don't own the shares. I assume I can do a same-day sale, and, the company will help me through this, so I don't have to go borrow, as you said, money from my mother-in-law or something. Who do I ask for advice? Who do I talk to? Do I call Countsy? Do I call NPM? How do I know whether I should participate or not? What are your thoughts, either one of you, on that?
Gosh, well, my initial thought is if the company is offering a tender, they're going to have some, whether it's their people organization is going to be able to give people not personal tax advice, but some good information. And then, of course, there will come a point where they'll say, if you're trying to determine, your personal situation, you need to go talk to a tax professional. But most good companies will offer good information around the actual offering, like what the percentage is, whether it's taxable, etc. Shouldn't be a surprise to the employee how they're going to get taxed on it. Tom, do you have a different opinion there?
No, I agree, Martina. Every process, first with the company, then with the employees, starts with education. And you'd be surprised, Karine. In general, a lot of founders are heads down, focused on building their business, and their general level of awareness around liquidity and how these things work, it's just not been on their radar. And then all of a sudden, it kind of comes at them as an imperative. So it starts with educating founders and management teams on how this works. They always have two concerns. First is this going to be a massive time suck? Am I going to have a 3-month work stoppage? And that's where working with an experienced team like NPM is helpful, because that's our specialty, is making sure that this is not a distraction, that we got this, and you're going to be able to do your day jobs. The second is that it's going to be unsuccessful and that it's going to fail. And that has happened, but it happens very, very rarely. So that's where we start with management teams. Martini's right. Then with employees, there's always a lot of tax questions. There's, what do I sell? In what order do I sell them? And then on the other side, once they realize, well, for the first time, well, what do I do with it? I've never had money. What do I do? How do I set up an investment plan? Who should my tax advisor be? How should I think about insurance? Money is a blessing, but it comes with complications. And so we try to help, on both ends of the spectrum.
Yeah.
I wanted to point out some of these from the sources, that they are independent they are sharing the data with you. They're explaining that our activity revolves around entrepreneurs, startups, and you're muted, Mr. Vijay.
Thank you very much, Dr. Moradi. It was good to revisit that video by NPM and Tom Callahan's views, and it's very interesting. It never gets old to refresh the memory, and it's nice to know also that the oldest shareholders now can liquidate and move on, which is good for them. And it's also an avenue now where the private companies can raise capital, and according to Tom, they are ready within 48 hours now. That's really, really interesting. So we have come to the closing of our show for today. And as we have seen today, secondary share opportunities aren't just transactions. They are strategic gateways to unlock hidden value, accelerate growth, and position businesses for their next chapter. Whether you are an investor seeking smarter entry points or a company looking to transform equity into momentum, the key is vision, timing, and trusted partnerships. This is where informed decisions creating lasting wealth. Thank you for joining us on Tech Talk, where knowledge meets opportunity and opportunity meets action. Join us next week for Maxwell Rand Inc. and Quantum, unlocking growth, intangible asset valuations, and M&A strategies, and an announcement of a collaboration. Now, thank you very much for listening to us.
Thank you
Like,
for having us.
subscribe, and stay tuned as we continue to explore the tech transforming tomorrow's TV today. Thank you very much for joining us.
Cheers.